Most people believe that their money is safe in the bank. But what if I proved to you that your money is at even higher risk today than it was in 2008? And what that really means is if your wealth is unprotected, it may very well evaporate. And this is exactly why you need to be properly diversified with sound money gold and sound money silver, physical in your possession to balance any of that fiat money risk and debt. So first we have to start with a definition, because the biggest risk to your wealth, and I've maintained this ever since, are derivatives. So why do I say that your wealth is at risk in the banking system? Because of this. Derivatives are financial contracts that derive their value from the price of something else. Could be stocks, bonds, mortgages, weather, or even other derivatives, and they can all be commingled and mushed together. They're essentially just big speculative bets that can never be converted into anything real. Only this stuff, only fiat money. And these speculative contracts are controlled by the world's biggest, most interconnected banks called SIFIs. Do you remember that name after 2008? That also means systemically important financial institutions. And guess what? That includes your bank. Even if you're in a smaller bank, even if you're in a community bank or any of that, because all of those smaller banks and financial institutions are dependent upon the SIFIs, the systemically important financial institutions. Look, there have already been two major near collapses that were caused by derivatives, speculative derivatives. One was in 98 when long-term capital management was run by the smartest guys in the room, Nobel Prize winners and Wall Street legends. And it collapsed because they were boosting their returns with 30-to-1 leverage. That is insane. That's like having one little tiny piece of equity and lots, 30 times that in debt on top of it. Yeah, that's insane. And they bet wrong. And the entire global system nearly came down. But instead of fixing the problem, because they were too interconnected, it's that counterparty risk. You want to know what counterparty risk is? If long-term capital management failed, the whole system that is incestuously intertwined would have failed. Too big to fail. So the Fed bailed them out along with other Wall Street banks with the support from both parties, Democrats and Republicans. That's why I don't really care who's in the White House. Their job is to move it along, the whole process, and that's what they do, Democrat or Republican. And suddenly, your deposits were now mixed into a casino of high-risk bets. These guys were called the Committee to Save the World, but they didn't save it. All they did was paper over it. That's all they did, and then allowed even more risk-taking, along with all the deregulation. We're going to come back to both of those in a second, because we want to fast forward to 2008. Derivatives were at the core of the financial collapse. CDOs, CDSs, all this alphabet soup of letters, and really what it was were risky mortgages. So how does a garbage mortgage become AAA rated? Well, they removed from these mortgages the promise to pay that mortgage. And somehow with their very complex formulas, algorithms, they figured that with all of these risky mortgages in place, they suddenly became AAA rated. Well, they weren't AAA rated. They collapsed. And you can see in this graph that these complicated bets stacked on top of the mortgages are actually what killed the system back in 2008. But look at what Wall Street did with those toxic bets. They're growing again. And maybe they go to CLOs or whatever other alphabet soup. But so much of this has not yet been tested. But I promise you this, it will. Because no one went to jail. Instead, investment banks merged with deposit-taking banks or became banks themselves. And risky behavior, well, that was baked into the financial system because now Wall Street knows they're going to be bailed out. So what happened after 2008? Well, the illusion of reform and the Volcker Rule. Because the Volcker Rule was meant to prevent this from happening again by eliminating the ability of these banks to take speculative bets or to make those speculative bets. But frankly, those rules were gutted before they were even enforced, though not the bail-in rules. Those were in force, and guess what? They remain in force today. But bail-in laws that are now in place means that the next time your bank fails, they don't bail it out with taxpayer dollars first. They will do that. But first, they're going to bail in your money, your deposits, although it's just a perception that you have that they're yours. Once you make that deposit, you have loaned the bank that money. And guess what? That's the equity that they build all of these bets on because they are still speculating. Let's take a look at what that looks like because this is the most current chart from the Office of the Comptroller of the Currency, derivative exposure in the FDIC insured banks. And frankly, it is higher now than it was in 2008. And they didn't actually scale back. They doubled down because there's really no true secondary market for most of these derivatives, particularly the ones that were done prior to 2008. And they're still floating in the system. But those are typically done between two entities. Two. That's counterparty. So if they're only done between two, where's the rest of the market? That's why you have to own gold and silver physical in your possession because it has the most amount of functionality and the broadest base of buyer. These derivatives are typically between two or three entities, and it's those big banks that create them and can also rule whether or not they're in default, and that's how they keep them hidden. But there's really no secondary market for most of those derivatives, and you won't see it until they explode. So let me give you a better graphic of really what this leverage position is, and we're going to do that using JP Morgan, which has a huge amount of derivatives in the system. Okay, so let's just zoom in. And they report 3.5 trillion in assets. And that's that itty bitty tall spire on your left. But they also say that they have 47.4 trillion in derivatives. That's not leverage. That's lunacy. Because if those bets go down just 7.3% and they're wrong, the bank is insolvent. And those are your deposits that are part of that equation. And they've got all of those underwater bonds that we've talked about also as part of their equation. So if they start to sell that off, do you see that doom loop appearing? And can you see how these incestuously intertwined, systemically important financial institutions could crash the entire system, which is really what we need to move into their new money and give them even more control? I say no. I say let's do a quiet and peaceful revolution just by buying sound money, converting this garbage into real money. But let me show you what else is hidden, because I think that you can see that little picture of the White House and that little teeny itty bitty person, football fields. That is the level of leverage that is in this system that is being reported. Since 2013, regulators let banks net derivative exposure. So basically hiding the true size, because they say, well, this contract is pretty similar to this contract, so now we can just count them as these two contracts as one. And all of those regulators, and we're talking about the FDIC, the Federal Reserve, go to the IMF, the World Bank, the BIZ, all of them admit that they really don't know the true value at risk. What you're looking at in all of these numbers are the market value, that nominal value that the market gives them. But again, nobody really knows the true value of what's at risk. So now we have risk that we can't see. We can't measure it. Do you think we can stop it? Even better, do you think they want to stop it? Because they need a large crisis to move their agenda along. But it's really like an iceberg that we talk about. What's visible is only a little sliver. The real danger lies below in what we cannot see. So let's take a look at what we can see. And that's your deposits. Because you'd say to me, but, I hear this all the time. My deposits are insured, right? Well, that was also something that came in 1933 to give you confidence. But let's take a look at the DIF fund, Deposit Insurance Fund. So that pays out if a bank fails, or at least to its insured deposits. And that's all we're going to talk about here at the moment, because as of Q1 of 2025, the FDIC has reported that they have $141 billion in its insurance fund. But our deposits, yours and mine, we've deposited $10.8 trillion, and these are insured deposits. So what does that really mean? Do the math. That means that just over a penny per dollar of insured deposits can be paid out. Well, if one bank goes or another bank goes, it doesn't become visible. But it almost became visible in 2008. Frankly, that's not insurance. That's illusion. That's perception management. Because if they can manage how you think about things, then you move forward in what makes them comfortable. You leave your wealth at risk without realizing it. They want you to think that it's as good as gold, but it's not. Even the physical representations of the digital assets are primarily, look at that. This is my not real Bitcoin. This is my real gold coin. Look at how similar they look. It's an illusion. Don't be fooled by the illusion. Go to the real thing. Always go to the real thing. Because with derivatives, you can't convert them into anything. And with this stuff, well, you have your own opinion on that. So what I also want you to be aware of is the test that's been going on, because we remember the bank closures that happened in 2023. What happened in October of 2024? Well, First National Bank of Lindsay Falls quietly closed. No warning. And they don't have to give you warning. And the uninsured depositors, they got back just 50%. The rest, poof, gone. Because when your bank fails, that's when you find out. And that's when it's too late to do anything about it. That's why you need to call us. You need to get your sound money strategy in place, because that's going to make sure that if and when that happens to you, You are made whole. Because quite honestly, even now, regulation is being stripped away. President Trump's top regulator, expected to be friendly to Wall Street. This leads the Fed's deregulation charge, and it's pushing to weaken capital and liquidity requirements again. So really, what is real insurance? Because what you're looking at here are gold derivative growth in the FDIC insured banking system. And hey, they did change some of the rules in 22, but you can see from this that they've been lying to us right along. And do you really trust that what you're seeing is accurate? Because what I'm seeing when I look at this graph is a whole bunch of price manipulation by those big banks whose job is to keep you in the system and away from sound money. It is critically important that you have that sound money position, as well as food, water, energy, security, barterability, which for me is primarily silver, wealth preservation, which for me is primarily gold, community, which has become arguably the most important part of the mantra, and shelter. These are the things that we need. And so I want you to just remember this. Since 2008, that is the official level of purchasing power decline, because all they do is print more money and transfer more wealth to keep you in the system. But your dollar has lost massive amounts of purchasing power. And in this next crisis, you're not just at risk of loss, you're at risk of confiscation through bail-ins and destruction through inflation and hyperinflation. But equally important, maybe even just a little bit more, but I'm not sure about that. But it's the global community demanding redeemable gold as part of the new financial system. I can't guarantee that this is going to work. I have no idea how to really grow a global sound money movement, but I do know that nothing happens if we never even try. I'm one person. What can I do? I could talk to you. You can join me in this endeavor, because I also know that together we can do anything. And until next we meet, please be safe out there. Bye-bye.